Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to talk to you a little bit about a really common tax myth that I hear perpetrated all over the place. And I think it's fueled a little bit by media narratives that are wrong, by little clips on TikTok and Instagram that are wrong. And so as a result, I want to clear that up a bit today with respect to kind of how you can structure your tax affairs, in particular for a business, but it could also apply to an individual. So we're going to dive in and talk about it today. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. Welcome if it is your first time here. Thank you if you're been here before. Also, thank you. Very appreciated of you to be here with us. And if you have not been here before, we are some of the international tax experts in the world. Michael is my name. And we help with people who are interested in relocating to other countries, with people who are wanting to get residencies, citizenship, set up Plan Bs, set up companies in other countries, optimize their global tax, figure out how to hire people in other countries and invest in other countries, and all that fun stuff. If those things are things that you're interested in, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message through offshorecitizen.net. Okay, so let's dive in. So what is this kind of royalties myth? So I'll just kind of characterize it as what people tend to believe is they tend to think, oh, well, what all these big companies do is they put their IP over in country B and they charge a license to company A and they suck all the profits out, and that's a zero tax country, and so they don't pay tax, okay? So let's just use a random example. Let's just say they think, oh, well, Nike has a valuable brand, and so how does Nike structure their tax affairs? Well, they probably have a US company, and the US company makes a ton of money, but they don't own any of the IP. The brand is actually owned in a company in Bermuda or Bahamas or whatever, and that company is charging for most of the profit. They suck it out. They have almost no profit left in the US. They pay almost no tax in the US. They have all this fancy money overseas. This is almost entirely false, okay? Almost entirely inaccurate. This is not what happens. And there's a few reasons why this is not what happens. The first is anytime a company has to deal with itself in different countries, this creates something called a transfer pricing arrangement. And so they're only allowed to charge a fair arm's length standard, which is fairly aggressively scrutinized by the tax authorities. So they have to do something called a transfer pricing study, and they have to do all sorts of extra reporting every year. And if they're found doing what's called transfer mispricing, then they can be fined. In the US, that's like up to 4 times the tax that would be the differential. So it can be quite punitive. And generally speaking, when we're setting up structures for people, we try as much as possible to avoid transfer pricing. There are cases where transfer pricing is useful. It's used by lots of big companies. It's fully legal, but it's got an administrative burden on it that we would rather avoid in most scenarios, okay? So that's the first thing. It's just they don't get to say, hey, I'm charging an unlimited amount. There's no profits in this company. No. They have to say, well, realistically, that company in the US needs to have a fair profit margin, and so maybe we can take a 5% royalty or something like that, which might be useful for a big company. That still might be a lot of money, but that's the case. Now, the second reason why they don't do this is because in a lot of cases, in most cases, I would say, there's something called royalty withholding taxes. So in the US, for example, you're typically talking about a 30% royalty withholding, okay? So if you had a company in, let's just say, Bermuda that doesn't have a tax treaty with the US, and it charges licensing fees or royalty fees to the company in the US, that income it's pulling out is subject to a 30% tax on the gross, which actually might be much worse than just paying the 21% corporate tax locally. So it doesn't make any sense at all that they would do that. Now, there are some cases where you have, for example, the EU Royalties Directive, and so moving money around within countries, within the EU, there can be some nuances there, and so there are some real fine subtleties that show up in some of these situations. So for example, there's this very famous structure, not really used so much now, but back in the day, it was called the double Irish with the Dutch sandwich. And so you'd have 2 companies in Ireland, and money would flow from Ireland to Netherlands back to Ireland. There's a whole bunch of reasons why that would happen. But the point is, for the most part, this is not what's going on. Now, let's talk a little bit about what does go on more realistically. So first of all, as a general rule, you want the foreign company to actually be the one that's charging customers, okay? That way you're not having the foreign company do business with your local company. You avoid this whole transfer pricing thing, okay? So now, That depends on how the substance is, like do you actually have employees there, where are the operations, what's the fulfillment, where are the sales taking place, how are you generating sales, what's the type of income, lots of different factors, right? So there's no one size fits all. I'm giving you kind of a generalization here. But what you'd normally have is you'd normally say, okay, the foreign company is going to deal directly with my customers, if at all possible. Good example of this, Google was doing sales to the French market, and they had a sales office in Ireland. So what they would do, Ireland has a 12.5% corporate tax rate. France is one of the worst tax countries in the world. And so they would say, okay, let's have all the sales getting done through our sales team through the Irish office so we can pay the lower tax rate as opposed to the higher tax rate. Okay, so that's an example of something that would more reasonably happen. Another thing that will happen is you'll have something called cost-sharing agreements. So this is actually a form of transfer pricing. This is kind of legitimate in that regard. This is what Apple has done for quite a long period of time. And what they'll do is they'll say, okay, Apple will pay for a certain portion of the R&D costs from one of their foreign companies. So in this particular case, there was for a long time an Irish subsidiary. Not anymore, it's kind of changed now. But back in the day, they used to have an Irish subsidiary. People get confused about that because it wasn't actually an Irish resident company. There's a nuanced distinction. I've talked about this in some previous videos. Anyway, so that company would help to pay for some of the R&D costs in the US. That transfer of money, let's say they're going, okay, we're building a new iPhone, it's going to cost us $1 billion. So they say, okay, great, our Irish company will pay 60% of that cost. It's going to pay $600 million to the company in the US. This means the company in the US is going to make $600 million, which it will pay tax on. Okay, it will be fully taxable on that. But what it's getting in exchange for paying that is the distribution rights for that product to a certain share of the world. And they kind of negotiate that with the IRS in advance. In particular, in this particular arrangement, what it would be was they would get the right to all the global distribution outside of the Americas. They kind of figured that was fair. Now what this does, in effect, is because there's much more to the overall cost than just the cost of R&D, you disproportionately shift a larger share of the profit margin to the Irish company where the taxes are lower. In this particular case, basically the taxes were zero. They aren't today, but again, different scenario. And so because of that, you would end up in a case where, okay, you can take advantage of getting a lower tax rate on that portion of the income. Note that that company is then dealing with all the customers internationally or across the non-Americas, as in the situation I was mentioning before, but you needed to have that transference of rights. Okay, so that's another scenario. There's a third reason why this often doesn't work, which is because there's something called controlled foreign companies rules. I've talked about this lots in previous videos, et cetera, but essentially the way these rules work are, even if you have a foreign company that you manage to make money, and it made money at, say, zero tax, let's just say, and you say, okay, great, I'm gonna leave the money there. They will force you to attribute that to your local country and pay tax as though you received that money into the local country, even if you did not, okay? Complex situation, and so one of the biggest things we're planning around anytime we're looking at somebody's situation is what are the CFC rules that apply here? What are the controlled foreign companies rules? And therefore, what needs to be in place to make sure that you're fully compliant with those rules and you're still able to optimize the tax as much as possible. Anyway, that's a little bit of an overview of the situation. I wanted to clarify for people this thing because I hear it a lot, this myth of oh yeah, we're just going to charge the royalties. It would be wonderful. It would be wonderful, but it's not true. So if you are interested in help with kind of how to optimize for your particular country, set up some sort of a legal structure, et cetera, please reach out to us, book a call with me, and I will see you guys on the next video.